Hi there, I'm Tarek, founder of Blue Pencil Digital Marketing. Thank you so much for taking the time to check out my free lecture. In this lecture, I will give you a solid framework on how to define the right digital marketing KPIs for your business. Now, this is a framework that I've been using for years with my clients. It's proven and it works for any business regardless of the sector. All right, without further ado, let's jump in. KPI stands for Key Performance Indicators. And as you can see from the name, these are important metrics that tell you everything you need to know about your performance. These are indicators of whether your performance is on the right track. Now, throughout my career, I've seen two problems with a lot of companies. First problem is that a business would think they have KPIs, but in fact they don't. For example, a company says our KPI is increasing traffic, and that's it. That's their KPI. But that's not really a KPI because it doesn't have any context. So by how much do you want to grow your traffic? And in what period of time? Is it a 10% growth in 3 months or a 50% growth in 6 months? There's a huge difference in the clarity of the KPI. Second problem I've seen is that businesses would have the wrong KPIs for their activities. For example, a business would have the KPI of increasing conversions by 5% monthly, but they're running marketing activities that are more geared towards brand awareness, example, display ads or YouTube ads. So what happens is they keep running those ads, expecting that they will generate conversions, but they end up never achieving their KPIs, simply because they had the wrong KPIs in place, not because the campaigns are bad. It's just not the right KPIs to look at. So the problem with KPIs is that it's a double-edged weapon. If you're looking at the right KPIs, it will lead you to the right path of achieving your objectives. If you're looking at the wrong KPIs, it will misguide you away from your objectives. You might think something looks bad on the surface, but in reality it's actually serving your objectives. Or the other way around. You might think something is going well, but in reality it's not serving your objectives. And this usually leads to frustration. You start doubting your strategy, then you doubt your team, then you doubt your own judgments, and you go down this rabbit hole unnecessarily. The first step to identifying the right KPIs is to determine your objective. Now, if you look at any business from a top-level standpoint, at any given point, the business will be looking at one or more of these marketing objectives. Either they're trying to get more visibility, so they just want to reach as many relevant eyeballs as possible, or they're trying to drive traffic to their website or app, or they're trying to generate conversions, so they want people to take an action on their website or app. And here I'm talking about any form of conversion. Could be an online order, could be lead generation, could be any form of engagement like viewing more than 5 pages per session. Whatever the conversion is. These are pretty much all the top-level objectives of any digital marketing activity. Now, if you look at these objectives, you'll see that they mirror the stages of the marketing funnel. This is a simplistic funnel. I'm sure you've come across more granular funnels consisting of 5 to 6 stages, but these are really the core stages of any marketing funnel. So the objective of visibility will be serving upper funnel users to drive awareness. The objective of traffic will be serving mid-funnel users to drive consideration. And the objective of conversions will be serving lower funnel users to drive decision and action on your website or app. Now, to determine the KPIs for each objective, I've broken them down into 3 dimensions of KPIs, or 3 types of KPIs. So you'll have volume KPIs, relevance KPIs, and cost-effectiveness KPIs. You will see what that means in a second. But the reason why you want to identify these types of KPIs for each objective is because this gives you a more complete view of your performance. So let's start with visibility. In this objective, the volume KPI is going to be impressions. That's the standard KPI to track brand visibility across any channel really, whether it's SEO, paid search, social media, display ads, etc. The cost effectiveness KPI here is going to be CPM, or cost per 1,000 impressions. Why is that important? Because it tells you whether you are cost effective at driving these impressions. So generally, the lower your CPM, the better. You as a business always want to improve your cost effectiveness. Without this cost effectiveness KPI, there is no way you can improve your performance over time. So for example, if your objective is visibility, you could say our KPI for the next month is to drive 500,000 impressions at a CPM of $2. Now, in some cases, you might want to have a secondary set of KPIs for your visibility campaigns, and those would be video-related metrics. So in case you're running video ads across, for example, YouTube or social media, you might want to have a separate set of KPIs for those video campaigns. So the volume KPI would be video views. Cost effectiveness KPI would be CPV, or cost per view. Again, tells you how cost effective are you at driving those video views. And now I wanted to introduce a new type of KPI, which is relevance. So relevance is a percentage KPI. In this case, it's the percentage of views generated from all the impressions. So out of all the people that have been exposed to your brand, how much percentage of them actually watched your video or a part of it? So of course, the higher this percentage, the better. It means more people are finding your content relevant. Let's move on to the traffic objective. Here our volume KPI is clicks, or website visits. In the case where you have a mobile app, your volume KPI is going to be app installs. Your relevance KPI is CTR, or click-through rate. This simply tells you how much percentage of clicks generated from all impressions. So again, the higher your CTR, the more relevant your content is to your audience. And finally, cost effectiveness KPI is going to be CPC, or cost per clicks, in the case of websites, and CPI, or cost per install, in the case of a mobile app. So for example, if your objective is traffic to a website, you could say our KPIs for the next month are to drive 1,000 clicks to our website with a CTR of 5% and a CPC of $1.5. Moving on to our last objective, conversions. Here your volume KPI is conversions. How many conversions? The relevance KPI is conversion rate. Again, the same idea. It tells you how much percentage of conversions have you got out of all the clicks or website visits. The higher your conversion rate, the more relevant your offering is to your audience. And finally, cost effectiveness KPI here is CPA, or cost per acquisition. An acquisition here is the same as conversion, just different naming for it. CPA again is a crucial KPI for your conversions objective because it tells you if you're being cost effective at driving those conversions. In some cases, if you're an e-commerce business, you might have an additional set of KPIs related to revenue. So you would look at how much revenue you've generated. You would also look at ROAS, which stands for return on ad spend. And this measures your cost effectiveness at driving revenue. You obviously want this KPI to go higher over time because it means your revenue is higher than your marketing spend. So by looking at these metrics here, you can easily identify the KPIs you need to focus on that can best serve your objective. Now, the next question is, what numbers exactly should go into each one of these KPIs? So we know that conversion rate, for example, is the right relevance KPI for conversions, but what percentage exactly should be our target? Should it be 1% or 5% or 10%? And how can you determine how much marketing budget is required to achieve your KPIs? So let's look at two scenarios. An e-commerce business, that's a business where the customer transaction happens online, on the website or the app. So in this case, when we say conversions, we're actually referring to customer transactions. The second scenario is lead generation business. That's a business where the customer transaction doesn't happen directly on the website. So a conversion here could be something like filling a form or calling the business. Let's look at the first type, an e-commerce business. Now, in order to identify the actual targets for your KPIs, you need to work this out backwards. You need to ask yourself, how many customer transactions do I want? That's a relatively easy question to answer for most business owners. Every business owner I've met had an idea on how many customers or how much revenue they want to generate for the next 3 or 6 months, for example. So let's say you want to generate 100 transactions or conversions. The second step is to translate those conversions into clicks, meaning how many clicks do you need in order to generate those conversions. To determine that, you need to figure out the conversion rate, because that's the connecting point between clicks and conversions. It's the percentage of conversions out of clicks. So how can you get that conversion rate figure? Well, you have two ways. Either you have historical data, so you look at your web analytics tool and see what was your conversion rate for, let's say, the last 30 days. Or if you don't have any historical data, you can get industry average benchmarks. There are reports and research online that can give you average conversion rates for your industry per channel. One place I recommend is WordStream. They release those kinds of benchmarks every year. So let's say you assume a conversion rate of 3%. This means you need 3,333 clicks to generate those 100 conversions. Next step is to translate those clicks into spend. And your connecting KPI here is CPC. Again, you can get it from your historical data, or if you don't have any, you can find average industry benchmarks. So let's say you assume a CPC of $1.5, which means you'll need $5,000 in order to generate 3,333 clicks. Next step is to calculate your CPA. And that's simply dividing your spend by conversions. So in this case, your CPA is $50, which means every conversion will cost you $50 according to this plan. Finally, you need to compare the CPA to your average transaction value or average order value. Why? Because you want to see if you're making a margin on every transaction you generate through marketing. For example, if your average order value is $80 and you're spending $50 to generate that order, then you know you're running a positive ROI. Now, of course, this is not factoring in other operational costs. This is just to show you a simple example. So if you have that picture in front of you, before even starting your marketing campaigns, you have a pretty good idea on what KPIs exactly you need to monitor in order to achieve your objective. It also makes it easy for you after launching your campaigns to see where the problem is. For example, if you notice that your average CPC is $1, which is better than your target, but your conversion rate is 2%, which is below your target, then you know where the problem is. Or maybe you're on track with both your CPC and your conversion rate targets, but you're just simply not spending the full budget. So it really gives you a very powerful guide for monitoring the performance of your campaigns. And by the way, this can apply to all channels, not only paid media. So you can apply this to SEO or email marketing even. And in those cases, you would skip the cost KPIs like CPC and spend and look directly at conversion rate or volume of traffic, because these are organic channels. All right, let's look at the other scenario of a lead generation business. Again, we start with our end goal. So let's say our target is to generate 50 customers. Now, because in this scenario, a website conversion is not equal to a customer transaction, we have this additional step where we translate customers into website leads or conversion. And you do this by identifying your lead to customer ratio. In other words, if you receive 100 leads, how many of those can you convert into customers? This ratio is something that you will have to figure out from your internal records. Or if you're starting out, you can have an estimated lead to customer ratio. This ratio really depends on the performance of your sales team. Let's say in this case we'll assume 30%. Remember that you can always adjust these KPIs after you launch your campaigns and see the actual data. So now we know we need 166 website leads or conversions in order to generate 50 customers. Next step is to translate those conversions into clicks. Similar to how we did with the previous scenario, assuming a conversion rate of 3%, we will need to drive 5,533 clicks. Then assuming a CPC of $2, so we'll need a budget of $11,000. Next step is to calculate the projected CPA, which in this case is $220. And finally, you compare that CPA to your average customer value to determine the ROI of this plan. So again, similar to the e-commerce scenario, you have a very clear picture of what KPIs you need to monitor and influence in order to achieve your objective. Now, I wanted to further expand your view to have a more sophisticated look at your KPIs. So in this case, we have identified our target CPA to be $220. Now, if your average customer value is $150, most people will immediately think this is not profitable, right? Because you're spending more than what you're making on that customer transaction. But what if this one customer bought from you again a month later, and then bought another product or service 3 months later, and then bought again 6 months later? Now things start to get more interesting. And this is what we call customer lifetime value. So let's look at this scenario. You paid $220 to acquire a customer. That customer brought you $150. A month later, that customer buys another product, or maybe upgrades their service with you. So they pay another $150. Now the total revenue that you have made from that customer so far is $300. Then on month 5, that same customer buys from you another product or service for another $150. So now the total revenue that you have made from that one customer is $450. Then in month 12, that customer buys again for another $150. So now the total revenue you generated from that one customer over their lifetime is $600. Now what do you think of that $220 CPA? Is it good or bad? Because in the very beginning, that CPA didn't look good. But when we expanded our time horizon, the profitability actually looks pretty good. So the lesson here is that when we look at the lifetime value of a customer, we get a much clearer view of things. We become more informed about what's working best for us. Now, there are 3 main benefits from knowing your customer lifetime value. The first benefit is that you understand what are your most valuable customer segments. Is it males or females? Is it younger or older customers? Is it people living in city X or city Y? Of course, in order to obtain this kind of data, you need to have a proper CRM platform in place where you can track the purchase history of your customers, segment your database of customers, and more. So by knowing the most valuable customer segments, you're able to target those customers in your own marketing, or maybe you're able to serve them better. The second benefit of knowing your customer lifetime value is that you have a much better understanding of your most valuable digital marketing channels. For example, let's say you ran campaigns on Google Ads, display ads, and social media. From the initial analysis, you see that social media has the best CPA. But when you dig into the data and evaluate the lifetime value of the customers generated from each one of these channels, you might realize that actually display ads is more valuable on the long run. So this kind of insight is extremely valuable for you because it tells you where to focus more of your budget. The third benefit is in planning and setting the right target CPA. So back to that scenario we did, we had $220 as our target CPA. If we know that our customer lifetime value is $600, we will immediately understand that $220 is actually a good CPA. We might even give ourselves a higher CPA target in order to expand our advertising reach and marketing spend. So really knowing your customer lifetime value makes things a lot more clearer. These are the steps to calculate your lifetime value. I won't spend time here because it's very straightforward. Basically just a series of calculations, all based on your internal historical data.